Let me say that EPS is the amount of earning, for the period, is the amount of earning for the period, is the amount of earning for the period, is the amount of earning for the period, attributable to each ordinary share, attributable to each ordinary share, attributable to each ordinary share. Full stop. Then I have to see that there are two types of EPS. There are two types of EPS. There are two types of EPS. Number one is the basic EPS. And then number two, we have diluted EPS. So those are the two types of EPS, the basic earnings per share and the diluted earnings per share. Let's start with the first one, basic EPS. Basic EPS. Stroke, it's also known as capital structure. Simple capital structure EPS. Simple capital structure. Simple capital structure EPS. You see that? Basic EPS, basic EPS, basic EPS, basic EPS only considers, basic EPS only considers, basic EPS only considers the issued ordinary shares, only considers only the issued ordinary share, only the issued ordinary share. Full stop. It's determined as follows. It's determined as follows. Determined as follows. So to get the basic earnings per share, you take the earnings attributable to ordinary shareholders which is equivalent to profit after tax minus the preference dividends. Then you divide by the weighted average number of ordinary shares. So you take the earnings attributable to ordinary shareholders, which is equivalent to profit after tax, you minus the preference dividend, divided by the weighted average number of ordinary shares. So it's the total earnings attributable to ordinary shareholders. That means you have deducted any amount claimable by other stakeholders, and then you divide by the weighted average number of shares, not just the number of ordinary shares, but in this case, we are talking about the weighted average number of shares. What do you mean by weighting of the shares? Now, weighting of the share, assume that we have financial that start on 1st of January. Let's work with 2022. That means this financial year will end on 31st of December 2022. Assume an investor had invested in companies of XYZ Limited, and at the beginning of the year, as at 1st of January 2022, he had 1,000 shares. That's at the beginning of the financial year. Then on 1st of July, that's 6 months to end of the year, he acquired an additional 1,000 shares. So that means at the end of the financial year, this investor will be having a total of 2,000 shares. Now assume that at the end of the financial year, the company declares a dividend of 5 shillings per share. 5 shillings per share. This investor will get a dividend of how much? You get an amount of 10,000. It's not 10,000. Now this is how it works. This is how it works. You see, For the first 1,000 shares you had invested at the beginning, the money have been working for the company for the entire year. Are you together? So that means for this 1,000, all the 1,000 will qualify for full dividends. So you weight them, have been working for the company 12 of the 12 months, you get 1,000. But you see, the additional 1,000 shares were invested 6 months to the end of the year. So that means that amount you invested in that company have helped the company to generate the income only for 6 months. So there is no way you can get the dividend for the full year. So in that case, what happens? You weight them. So these 1,000 shares, it's 6 of the 12 months, and you get 500. So that means the shares that will qualify now for full dividend, that's what we call the weighted share, it's 1,500. So we'll take now 1,500 each, then you multiply by the dividend per share. But the issued shares is 2,000, but the weighted share is 1,500. That's why we say that you divide by the weighted average number of shares. Write another paragraph here to say that weighting of shares, weighting of shares, weighting of shares is an activity. Weighting of shares is an activity. Weighting of shares is an activity whereby the shares outstanding, at the beginning of the period. It's an activity whereby the shares outstanding at the beginning of the period, are adjusted with shares issued, during the accounting period. Shares issued during the accounting period. Full stop. This is usually done by multiplying the number of shares issued during the accounting period, by multiplying the number of shares issued, during the accounting period, by time weighting factor. Yeah, so this is what we mean. You multiply by the number of shares issued during the period, then you multiply by the time weighting factor. Good. So now let's look at issue of shares. During accounting period. Issue of shares during the accounting period. Wait, right? There are two types of share transaction. Semicolon. Number one, ordinary shares issued at consideration. Ordinary shares issued at consideration. And number two, ordinary shares issued at no consideration. 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 Yeah, those are the two types of share transaction. So you think that number one, you have the ordinary share issued at consideration. This is where the company will issue the shares and then they receive the new resources. Now, for example, IPO, where the company will sell the shares, the new shareholders will pay for those shares. That's what we call the issue of share at consideration. In short, the company is getting new resources. What about the issue of shares at no consideration? This is where the company issues new shares but receives nothing in return. For example, if the company effects a bonus issue of share, you give the bonus share to the existing shareholder. That means you are giving them for free. In that case, the company does not get any new resources. Now let's start with the first one. Issue of shares at consideration. Issue of shares at consideration. Issue of shares at a consideration. Let me see that. This occurs where the company receives, new resources. The company receives new resources in exchange for its equity, shares. In exchange for its equity shares. In exchange for its equity shares. Full stop. Then I have to say that the number of shares issued, the number of ordinary shares issued, the number of ordinary shares issued are weighted effectively from the date the company receives the new resources. Are weighted effectively from the date the company receives the new resources. Are weighted effectively from the date the company receives new resources. And now we look at number 2, issue of shares or issue of ordinary shares at no consideration. Issue of shares at no consideration. Right, we see that? This occurs whereby the company issues its ordinary shares. The company issues its ordinary shares and receives nothing in return. 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 Full stop. In bracket, no new resources are received by the company. No new resources are received by the company. No new resources are received by the company. Full stop. Did I say that? In this case, the company utilizes, existing resources. The company utilizes existing resources to finance those issue of shares. 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 Yeah, so you're saying that in this case, the company utilizes its existing resources. What does it mean? Now, when a company issues shares, maybe additional 1 million shares, and assume the par value was 10 shillings. That means it's 10 million. And then they give these shares at a bonus. So what will happen? You see, the company issued shares. You see, we expect, if the company issues shares worth 10, let's assume it's on cash consideration, you expect to get new cash. So that means you debit the bank account, you credit the equity. But in this case, the company have issued shares, but have received nothing. So that means you cannot debit the cash, but the equity has increased. So in short, the ordinary share capital will increase by 10 million. So that means you credit the equity, that's the ordinary shares. So which account will you debit? Because there must be a double entry. You debit? You debit expense. This is not a normal expenditure. It's a capital expenditure. A capital expenditure does not go to the income statement, therefore cannot be an expense. Not unless it's a share-based payment. Not unless it's a share-based payment. Can you read the last statement you have indicated? Say that. How does the company finances this free issue of shares? The uses what? Existing resources. So which are those resources? Those are reserves. Are you together? Yeah, for example, they can do this. They transfer that amount from the retained earnings or from the revaluation reserves or from any other reserve. That's what we call, that one actually only affects the statement of changes in equity, transfer of reserve. So for example, assuming that the retained earnings was 8 million. So what happens? They just transfer 10 million from the retained earnings, they transfer to ordinary share capital. That's what means that we are utilizing their existing resources. NB. See that? Shares issued at no consideration. Shares issued at no consideration. Shares issued at no consideration are not weighted. Shares issued at no consideration are not weighted. Shares issued at no consideration are not weighted. Good. So now let's look at examples of shares issued at no consideration. Examples of shares issued at no consideration. Examples of shares issued at no consideration. Number one, bonus issue of shares. Bonus issue of shares. Number two, bonus element in rights issue. Bonus element in rights issue and share options. Bonus element in rights issue and share option. What is share option? What is share option? That was IFRS 2. What did you discuss about IFRS 2? We did it in class. Do you remember the share-based payment? Yes. What is share-based payment? I said what? Not we said. I said what? This is where the company buys goods and services and settles the amount payable through the issue. As simple as that. Or we see that is a situation whereby the company grants share to its own employees. Yeah. So you're saying that in this case, the bonus element in the rights issue. What's the rights issue? What's the rights issue? Is the issue of new shares to existing shareholders at a price below the market price. That's what we call the rights issue. When the company issues the shares to the existing shareholders at a price below the market price. So, for example, let's assume that the market price per share was 40 shillings, but they decide to offer because they're issuing to the existing shareholders. Yeah, the advantage of right issue is that there is less administrative procedure. Also, it's cheaper because in this case, since you're issuing the shares to the existing shareholder who already know the company, you don't have to print new prospectus. So there is cost saving. So that cost saving, they are attributable to give the shareholders the discount. Let's assume now they sell share at that 5. So they're given a discount of how much? 5. Now that 5 will be deemed, that 5 shillings will be deemed to be issue of share at no consideration. Is the bonus element. Number three, share consolidation. Share consolidation. Share consolidation. And number four, share split. Share split. Share split. To split is the opposite of share consolidation. What is to consolidate? Yeah, here. What is to split? Yeah. And what are some of the circumstances that give rise to share split? Share split. Yeah, mostly happens when the market price is too high or the offer price is too high. Okay, we find that one share is going for 200. That's one share. So they decide that instead of selling this share at 200, let's now this share be 2 shares. 2 shares, each at how much? 100. What is to consolidate? One share to come to one. It's all about combining, right? Yeah. So those are the examples of shares issued at no consideration. The bonus element, I mean the bonus element in the rights issue or the share option. Also the bonus issue of shares, share split, and share consolidation. Yeah, let's define contingent issue for ordinary shares. Contingent issuable ordinary shares. Yeah, what's that? Contingent issuable ordinary share. We like to see that. These are ordinary shares. These are ordinary shares issuable in the future. These are ordinary shares issuable in the future. These are ordinary shares issuable in the future, subject to fulfillment, subject to fulfillment, subject to fulfillment of specific conditions. Subject to fulfillment of specific conditions. E.g., share options. E.g., share options. E.g., share options. Yeah, share options. Yeah, remember you said that mostly when the company is issuing shares or granting the shares to its own employees, the employees and IFRS 2, so that they have to fulfill some what condition are those? Vesting condition. Yeah, for example, one employee working for the company for the next 3 years. Now, those are examples of contingently issuable ordinary share. The shares that will be issued in future, subject to fulfillment of specific condition. Good. Take out your handout. Do some demonstration. Handout question 1, page 3. Mark Limited reported profit after tax of 112.8 million for the year ended that 1st of March 2014. That 1st of March 2014. That's at the end of the year. Now, if the year ends on that 1st of March, that means the financial year had started on February. If the year ends on that 1st of March, that's the end, right? That means the financial year had started on? Correct. 1st April. So 1st of April. So the year ends 2014. So that means it started in 2013. 1st of April 2013. Actually, for EPS, the most important part is to determine when does the financial year starts and when does the financial year ends. Mark Limited reported profit after tax of 112.8 million for the year ended that 1st of March 2014. As at 1st of April 2013, now that's at the beginning of the year, the share capital of the company was as follows. 10 million ordinary share of 20 each, 20 million. So that's the balance brought down. Yeah, there was 10 million ordinary shares, 10 million, and we only weight the shares, not the share capital. So those are the shares starting at the beginning of the period. If the shares are starting at the beginning of the period, that means they'll be starting for the entire year. So the weight is 12 months of the 12 months. So the weighted share will be 10. And we only weight ordinary shares. Then there was 7.5%, 5 million cumulative preference share or 40 each. They say that we only weight the ordinary shares, not the preference share. On 1st of August 2013, 1st of August, the year ends on that 1st of March. So how many months end of the year? Kindly engage your fingers. Nasikia 5, nasikia 6. Engage your fingers. I want one answer. On 1st of August 2013. How many months? Haya, sasa nimesikia 5, 6, nimesikia 8 tena. Nimesikia 7, Which fingers are you using? Yes, you're getting how much? You are getting 4, Now let me repeat again, On 1st of August 2013. Now, when does the financial year end? That 1st of March. So from 1st of August to that 1st of March, how many months? They're 8 months, right? Now they are not 5, they are 8 months, correct. On 1st of August 2013, the company issued 5 million shares at market price. So there was issue of shares at market price. They issued 5 million, 8 months to end of the year. Now, let me insist on something. And that's why I always aggregate that. For EPS, determine when the year starts, when the year ends. Then when counting the months, don't use whole head. Use your fingers. Are you together? Because hapa ukikosea kidogo yote, umekosea yote. Just the period, only the period. Because wrong weighting, wrong answer. And then it will destroy everything in that question. So you need to be very keen when coming to the counting of the months. So 8 over 12. What do you get? Hey, give me the answer. Sorry? 3 million? Like that, Then after every share transaction, we sum up. So the issued shares, it's 15 million, but the weighted shares is 13 million. Then the recurring like that. Good. Then I told that on 1st of March 2014, 1st of March 2014, 1st of March 2014. The year ends on that 1st of March. How many months at the end of the year? 1, correct. On 1st of March 2014, 1 bonus share for every 3. So they effected a bonus. Bonus issue. What was the term? On 1st of March 2014, 1 bonus share for every? You just take 1 over 3. And then the number of shares outstanding was 15 million. A that of 15 you get? You get 5. Yeah, we are told that. On 1st of March 2014, 1 bonus share for every 3, or you can just do this. For every 3, you get 1 bonus. What about the number of shares outstanding? What about 15 million? They get a bonus of how much? That's why I'm taking 1 over 3. 1 bonus share for every 3 ordinary share to all the shareholders as at that 1st of December 2013 were issued. So they issued 5 million shares. Wait, how many months? How many months? 1. Can you go back to your NB? And what have you written? Issue of shares at no consideration are not what? Are not weighted. And you see that one example of issue of share at no consideration is the bonus issue of share. You don't weight in this case. So how do you argue? Now, this is how you argue. You just cross multiply. Or this is how you argue. 15 million, they got a bonus of 5. What about the weighted 13 million? They get a bonus of how much? This is what I mean. If 15 million got a bonus of 5 million shares, what about 13.333? They get a bonus of how much? So that's why say you just cross multiply. 5 million times 13.3 recurring, you divide by 15. You get? 4 million? 444. 444, 444, good. And then you see that after every share transaction, you sum up 15 plus 5, the number of issued shares is 20, but those deemed weighted is 17.7 recurring. Like that. And we are done waiting. Required. Basic EPS as at that 1st of March 2014. Basic EPS. So how do you get the basic EPS? Now, basic EPS, we say that you take the earnings attributable to ordinary shareholders, which is profit after tax. You raise the preference dividends, you divide by the weighted ordinary shares. So we have the profit after tax. The first paragraph, you do that. Mark Limited reported profit after tax of 112.8 million for the year ended that 1st of March 2014. So profit after tax was 112.8. That's the profit after tax. Then we raise the preference dividends. Then you're told that as at 1st of April 2013, the share capital of the company was as follows. So there was 10 million ordinary shares of 20 shillings each. Then there was 7.5%, 5 million cumulative preference share of 40 shillings. So 7.5, 5 million shares, preference share, each at 40. %7.5% of 20 million is how much? You get? You get 15, eh? 15. So how much will be the earnings attributable to ordinary shareholders? 112.8 minus 15. Sorry? 97.8, eh? 7.8. Good. So that means the basic EPS. So you take the earnings attributable to ordinary shareholder, which is 97.8 million. Then you divide by the weighted share. So the weighted share was 17 million, 7 recurring like that. And then for EPS, voice it into 2 decimal places. You get how much? 5.50. Correct. Good. So you can copy now. Let's do question number 2 of the handout. On 1st of May 2014, 1st of May 2014. Now, if the year starts on 1st of May, that means the year will end on that is of April, correct. So on 1st of May 2014, A Limited had been issued 500,000 ordinary shares of 10 shillings per value. So the balance brought down, they had issued 500,000 shares. Weight is 12 out of 12, 500. And then kind of note this. For EPS, you see when I'm marking with the number of shares, if it's 10 million, I'm writing 10 million. If it's 500, I'm writing 500. Don't write 0.5 because sometimes you get maybe 125 shares and other shares. Now, one share is much variable to a company. Are you together? So for the shares, don't just round off. So if it's 500,000, just write 500,000, not 0.5. If it's 10 million, just write the full 10 million in full. It's for your own good. Because a small rounding off can cause a very big variation to the earnings per share. Then you do that. On 1st of November 2014, 1st of November 2014, how many months end of the year? Engage your fingers. How many months end of the year? Remember the year ends on 30th of April, right? How many months end of the year? 6, correct. So on 1st of November 2014, the company concluded a rights issue. Rights issue. Listen up here. Whenever there is a rights issue, see that a rights issue is the issue of shares to the existing shareholders at a price below the market price. So in case there is a rights issue, we have those shares deemed issued at full price, and we have those deemed to be issued at a bonus. And you're told that on 1st of November 2014, the company concluded a rights issue of 3 ordinary shares for every 5. So you take 3 over 5. Then this one, the number of shares outstanding, 500, and you get that 300,000. 300,000. The company concluded a rights issue of 3 ordinary shares for every 5 shares held at an exercise price of 28 shillings per share. So the exercise price was 28. The market price per share just before the rights issue, that's the right price, was 35 shillings per share. So the market price was 35, but they issued at 28. Now the question is, if we are to issue these shares at full price of 35, how many shares could we have issued? So this I'll get now the shares issued at full price. Of the 300, we issued each share at 28, but the market price was 30. Now the question is, of this 300, if we are to issue at that 5 shillings, how many shares could we have issued? Give me that. $240. So how many months of the year? 6, eh? 6 over 12, you get 120. Then you see that after every share transaction, you sum up. So here you have 740. Here you have 620. Bonus share. The company issued 300 shares, but those deemed issued at full price was 240. So how many shares were issued at a bonus? 60, correct. Or alternatively, you do this, 300,000 shares. The issue price was 28, but the market price was 35. So that means they were given a discount of how much per share? 7. You multiply by 7 over the market price of that 5. You still get 60? Confirm that. You get 60, yeah? Good. How many months end of the year? 6, eh? Yeah. We say that the shares issued at no consideration, such as bonus, are not with. How do you argue? You cross multiply, eh? No, not cross multiply. How do you argue? Before you cross multiply, eh? How do you argue? We say that if 740, they got a bonus of how much? What about 620? They'll get a bonus of. That's what we mean by now you cross multiply. You get 50 to 70. Then after every share transaction, you sum up 800,000 shares. This is 670 to 70. I think we are done waiting. Then you are told that the profit attributable to equity shareholders for the year ended 30th of April 2015 was 22.5 million. Required basic EPS as at 30th of April 2015. Basic EPS. So you see that to get the basic EPS, you take the earnings attributable to ordinary shareholders, which is equivalent to profit after tax minus preference dividends. So you take the earnings attributable to ordinary shareholders, then you divide by the weighted number of shares. So earnings attributable to ordinary shareholders, you are told it's 22.5 million. Then you divide by the weighted shares, we have is 670 to 70. And you get how much? That 3.57. Good. Can copy. 2019. November 2019. Question 5. Question 5A, November 2019, question 5A. Dakika Limited has prepared its consolidated financial statement. So that means it's consolidated. This means it's a group of companies. So it's November 2019. Question 5. Dakika Limited has prepared its consolidated financial statement for the year to 30th of September 2019. 30th of September. That's at the end of the financial year. So when had this financial year started? 1st of October, correct. If the year ends on September, the financial year started on 1st of October. Good. Extract of which are shown below. Also provided below are extract of the consolidated financial statement for the year to 30th of September 2018. So here you have two financial years. So the first one ends 2018 and 2019. Now for 2018, that means that started on 1st of October 2017, will end on 30th of September 2018. Then the other one will start on 1st of October 2018, will end on 30th of September 2019. So we have that. You have also obtained the following information in respect of the company's share capital. Number 1, ordinary share capital as at 1st of October 2017 was 15 million shillings, made up of shares of 5 shillings per value. Balance brought down. We had how many shares? 15, right? Very wrong. Is it 5 or 3? 3. You see that we don't weight the share capital. We weight the number of shares. You see what you are given the share capital. 15 million shillings with a par value of how much? 5. So that means they had 3 million shares. Then you weight 12 over 12. You have 3 million. Number 2, Dakika Limited issued some 500,000 ordinary shares at full market value on 1st of January 2018. 1st of January 2018. How many months end of the year? 9, correct. See, the year ends on September. From January to September, how many months? 9. So there was issue at full price. And the company issued 500,000 shares, 9 over 12, that's 75%. You get 375. And then after every share transaction, you sum up 3.5 issued shares, that 375 weighted shares. Number 3, Dakika Limited also made a rights issue of 2 new ordinary shares for every 10 ordinary shares held as at 1st of April 2019. Is that the same financial year? You need to be very keen. When does the year start? When does the year end? Now, this was on 1st of October 2017. That means that year will end on 30th of September 20. But you're talking about the rights issue happened on 1st of April 2019. That means this financial year. Are you together? Yes. So what will happen? Now you close this financial year. Now you start afresh. 1st of October 2018 balance brought down. Now, the balance brought down is the number of issued shares, not the number of weighted. These were the shares issued, weighted during that financial year. But the full total number of shares issued was 3.5. Now, this 3.5 will be now the opening balance for the other financial year. So you'll be having 3.5, weight is 12 over 12, 3.5. Then you are told that on 1st of April 2019, how many months end of the year? That is to September. 6 or 5? Engage your fingers. 6 or 5? 6, eh? Let's read. Yeah, it's 6 months. Dakika Limited also made a rights issue of 2. What do you say about the rights issue? Good. So whenever you have a rights issue, we have those shares deemed issued at full price. And you have those deemed to be issued at a what? At a bonus, correct? Yeah. So you're told that Dakika Limited also made a rights issue of 2 new ordinary shares for every 10. So you take 2 over 10, you multiply by the number of shares outstanding, 3 point, that's 20%, 350, that's 700,000 shares, right? I said yes. Dakika Limited also made a rights issue of 2 new ordinary shares for every 10 shares held as at 1st of April 2019. The rights price per share was 42.5. Market price per share as at the same date was 48. So you multiply by the issue price. The issue price was 42 point. But how much was the market price? 48. So of the 700 shares, if you had to issue at full price, how many shares could we have issued? So you multiply by the issue price over the market price per share. 619? 7? 91, eh? So 92, eh? Then 6 months, right? 6 over 12. You get 3? 309? 8? 896. Then you see that after every share transaction, you sum up. This will be 41,19,792. And this one will be that 809, eh? 896. Good. Then bonus. 2 over 10 times 3.5, you get 700,000. The issue price was 42.5, but the market price was 14. So they got a discount of how much? 5 point. Then you divide by the market price, 48. So that is 700 minus that. That is 80 what? 80. It's 700 minus 61, 619. 80? 28. Bonus share, they are not weighted, right? What do? You cross multiply. Just cross multiply. Issue of share, no consideration, are not weighted. You just cross multiply. So just take 80, you multiply by that 809, divide by 4119. 74? 175. Then after every share transaction, you sum up. This is 4.2. What about that? 38? 38? 84? 070? 071. Good. Number 4. Dakika Limited also had 1,000,006%, 10 shillings per value, non-preference or non-redeemable preference share as at 1st of October 2018. But there's something I want you to adjust, though that one is irrelevant. Yeah. I'm the only one who's supposed to know that. Can you go back to note number 4? Dakika Limited also had 1,000,006%, 10 shillings per value. Now, that one should not be 10. It was supposed to be 100. Ongeza 0. Na usiulize nilijua aje. Required. Free marks, no. Why should you give you free marks? Now that one is irrelevant actually. That question. Eh? Yeah, okay, this is what I mean. You see that is an unredeemable preference share. Eh? So you want to determine the preference dividends. So can you take 6% of what? It's 1 million preference shares, right? Each at 100. Then you multiply by 6%. What do you get? Unapata? Unapata? Unapata 6 million. Eh? Haya, sawa. Haya. Required. The basic earnings per share for the year ended 30th of September 2018. Then number 2 is the basic earnings per share for the year ended 30th of April, 30th of September 2019. So how do we get the basic EPS? Now, basic EPS, you take the profit after tax, you raise the preference dividends, then you divide by the weighted shares. So you had 2 financial years. We had 2019, we had 2018. So you have the profit before interest and tax. That's the EBIT, earning before interest and tax. 2019 was 8830, 1712. That's the earning before interest and tax. Then we pay the interest. Interest of which we are given the finance cost. Finance cost is the interest. You minus 1045, 987. Once you raise the tax, you get now the earning before tax. Then you raise tax. You raise tax, and we have tax 17, 18, and then we have 12, 64, so that you get the profit after. Now, once you get the profit after tax, you raise the preference dividends. So you also raise preference dividends, which was an amount of 60, and then we have 60. But this is a group of companies. So being a group of company, there is amount attributable to non-controlling interest, and that's what you're given. Profit attributable to NCI, so that we get the earnings now attributable to the ordinary shareholders of the parent company. So euro, sorry, profit to NCI, 180, 160. That's how we get the earnings attributable to ordinary shareholders. Give me that. Sorry? 5827. $45.41. So therefore the basic EPS (2018, 2019). 2018 is 45.41. 2019, 58.27. Then you divide by the weighted shares. 2018, the number of weighted shares was 33.75, and 2019 we had 8.84071. Into 2 decimal places, that is 1 point. $1.35. This one is 1.50. Good. Can copy. Let's try another illustration. November 2015, question 4C. Start with part B of the question. Part B, I told that evaluate the potential problem that an investor might encounter in placing undue emphasis on the earnings per share figure. First of all, understand the question. Evaluate the potential problems that an investor might encounter in placing undue emphasis of the earnings per share. Actually, mostly for an investor, not just the shareholders, even for if you want to invest in a company, once you get the financial statement, you're not just concerned about the bottom line, the profitability. No, you have some companies which are much profitable, but the earnings per share is too low. Are you together? Yeah, for example, also Safaricom is very profitable. What about the dividend per share or the earnings per share? The more they have, the more the profit, the more they share, because we have a lot of subscribers, right? Yeah, so in that case, most of the shareholders, they look at what we call the valuation ratios: earnings per share, dividend per share, price earning ratio, earning yield, all that. Now, in this case, assuming that you're an investor and your major emphasis is on earnings per share, so what are some of the challenges you're likely to encounter? Now, let me make it easier for you. Now, the question is asking, what are the disadvantages of ratio analysis? EPS is part of the ratios, right? Yes. So what are some of the disadvantages? Andika. Let's write number one. You can just write challenges or limitation of ratio analysis. Number one, EPS is based on accounting data. EPS is based on accounting data. EPS is based on accounting data, which is prone to manipulation, which is prone to manipulation, which is prone to manipulation. Yes, the management can manipulate the financial statement so that they can achieve their objective by attracting new investors. Number two, it uses historical data. It uses historical data. It uses historical data. And so what are the challenges? See, as an investor, you're looking at the EPS to determine whether you invest or not invest, or whether to invest or not to invest. So that means you're using this, see, EPS, using the financial data for the maybe previous year or the current financial year at the end. So you're using the past data. But in this case, as an investor, you want to make a decision about the future, but you're relying on the historical data. So you're saying that, what have we indicated? It uses historical data to make future decisions, yeah, which are subject to uncertainty. Another one, ratios does not take into account, the effect of inflation, does not take into account the effect of inflation. Number 3, ratio ignores the time value of money concept. Ratios ignores time value of money concept. Time value of money concept. Another one, ratios does not capture the qualitative aspect of the entity. Does not capture the qualitative aspect. Yeah, that means it only considers the quantitative, not the qualitative aspect. Good. Number C of the question. Number C. Winam Limited, a limited company, has an authorized share capital of 4,000 million shillings, comprising of 600 million ordinary share, each at 5 par value, 5 shillings per value, and 50 million 10% convertible preference shares of 20 shillings each, and then 20 shillings. Yeah, so that means the ordinary share, the par value is 5, the preference share, the par value is 20 shillings. On 1st of January 2013, 1st of January, that's the beginning of the year. So if the year starts on January, the year will end on good December 1st of January 2013. So on 1st of January 2013, the company had in issue 160 million ordinary share. Can you add in 160? Those are the number of shares issued. And that million, 10% convertible preference shares. All the preference shares were fully paid, while only 100 million of ordinary shares were fully paid, the balance being 80% paid. Let me ask you a question, if you have understood. How many shares have we issued at the beginning of the year? 160. But of the 160, you told that only 100, which are fully paid. The balance being only 100 are issued, right? The balance being 80% paid. So now you want to determine the opening balance. So for the balance brought down, the company has already issued 160. But of the 160 shares, 100 are fully paid. Then you have a balance of how much? 60. 60 being 80% paid. So you multiply by 80. 80% of 60, that's 48, right? So you get 148. 12 over 12. 140. The following transaction took place in the year ended that 1st of December 2013 and that 1st of December 2014. So you have for 2 years. Number 1, the partially paid ordinary shares of 5 shillings per value were fully paid on 1st of April 2013. So on 1st of April 2013. How many months end of the year? April, January, February, March. 12 minus 3, you get how much? 9. So partially paid share. How many were partially paid shares? Angalia ni hapa iko hapo. Everything is here. You see, 100 was fully paid, right? The balance 60 being 80% paid, of which now 80% of 60 is 48. So you take now 20% of 60, which is an amount of 12. 9 months to the end of the year. 9 over 12, you get 9. Good. Then after every share transaction, you sum up 160, 150, 157. Number 2, on 1st of June 2013, how many months end of the year? 1st of June 2013. How many months? 5 or 6? 6 or 7? 7, correct. On 1st of June 2013, the company issued for consideration 72 million ordinary shares of 5 shillings per value at 8 shillings each in full settlement. The market price of the ordinary share on this day being 10. What is that? That's the right issue. Deemed issued at full price, and we have bonus. Sorry, 10. On 1st of June 2013, the company issued 72 million ordinary share of shillings 5 per value at 8. So the issue price was 8 in full settlement. The market price of the ordinary share on this day being how much? 10. You see, we issued at a price below the market. That mostly happens only for the rights issue. So since we give a discount, we have those deemed issued at full price and bonus. So the company issued 72 million shares at 8, but the market price was 10. 80% of 72, or 72 minus 14.4, you get? Sorry? 57.6. How many months end of the year? 7, eh? 7 over 12. That's 3 point. And then you see that after every share transaction, you sum up. This is 217.6. And this is 190 point. Then we have bonus. 72. The market price was 10, but we should at 8. We give them a discount of how much? 2 over 10 is 20%. 7 times 2, that is 14.4, right? Then, how do we get that? You cross multiply, right? Of which we say that this is how you argue. If 217.6, they got a bonus of 14.4. What about 190.6? So you just cross multiply. You get? 0.6. Then after every share transaction, you sum up. That is 2, that 2, right? This is 3.2. Good. Number 3. On 1st of September 2013, how many months of the year? 1st of September 2013. September, October, November, December. Those are 4 months, right? On 1st of September 2013, the company issued 48 million ordinary shares of 5 each at fair value. Fair value means what? Market value. Good. So that means we issued the share at full price. Eh? On 1st of September 2013, the company issued 48 million ordinary shares of 5 each at fair value of 12 shillings per share in settlement of the purchase consideration on the acquisition of property. So there was issue at fair value or at market value. And the company issued 48, 4 months to the end of the year. You get? 16. Then you see that after every share transaction, you sum up. That's 280, and this is 219.2. Good. Number 4. On 1st of March 2014, how many months end of the year? I told you you need to be very keen when it comes to when the year ends, right? This is another new year. Yes. This year ends on 31st of December 2013. Now that transaction is for 2014. So first of all, you close that financial year, then you start new financial year 2014. 1st of January 2014, balance brought down. How much the balance brought down? Correct. 280, the number of issued shares. So 280, 12 over 12, 280. Then you do that. On 1st of March 2014, how many months end of the year? So January na February, inabakia ngapi? 10. On 1st of March 2014, the company issued 1 fully paid bonus share for every 5 ordinary shares outstanding as at that 1st of December 2013. 13. So there was bonus issue. 1 for every. So just take 1/5 of the shares outstanding, 280. 280 divided by 5. That's 56, right? 56. Then shares issued at no consideration are not weighted. You argue. 280, they got a bonus of 50. What about 280? They get how much? 56. After every share transaction, you sum up. This one you get 332. 336. 330. Good. Number 5. Due to low market price per ordinary share at the security exchange, the company decided to effect a consolidation of share, also known as the reverse split, and issue 1 new ordinary share of 10 shillings per value for every 2 outstanding and fully paid ordinary share of 5 shillings each. This was done on 1st of August 2014. 1st of August 2014. How many months end of the year? 5 or 3? 5. The company effected consolidation. Share consolidation. What was the term? We read again. Due to low market price per ordinary share at the security exchange, the company decided to effect a consolidation of share and issue 1 new ordinary share of 10 shillings per value for every 2 outstanding and fully paid ordinary shares of 5. For every 2 you get 1. So that means if you had 1,000 shares, after consolidation now you'll have how many shares? 500, correct. So you just divide by 2. You get 160? 168. Also this one is 168. So here you had 336 shares, each at 5. Now you have 168 shares, each at 10. Good. 6. On 1st of October 2014. 1st October 2014. How many months of the year? 3. Good. On 1st of October 2014, a holder of 10 million, 10% convertible preference share converted these shares into ordinary shares. So there was conversion of preference share. Into ordinary shares. So you're told that on 1st October 2014, a holder of 10 million, 10% convertible preference share converted these shares into ordinary shares. The preference share were convertible into 8 fully paid ordinary shares of 5 shillings each for every 2 fully paid 10% preference share of 20 each. An appropriate adjustment for the number of ordinary share issuable on conversion of preference share is to be effected for any ordinary share split or consolidation that may be carried out. Preference shareholders are entitled to dividends up to the date of conversion of the share. So let's adjust that. So what was the term of conversion? We read the second sentence of note number 6. The preference share were convertible into 8 fully paid ordinary share for every 2 preference share. So for every 2 preference share, you get how many ordinary shares? 8. And then you're told that a holder of 10 million converted them. What about 10 million? 10 times 8, 80. 80 divided by 2, you get 40. Then you divide by 2. You get how much? 20. How many months end of the year? Part of 3. Yeah, 3/12. That's 25%. You get 5. Eh? After every share transaction you sum up, we have 188. We have 170. Kwa pamoja. Sorry? Ask the question before you proceed. Someni basi muelewe kama hamna swali. Do you understand why I'm dividing 40 by 2? Yes or no? No. That's when nimesema msome swali tena. Yes, to understand, correct. So I hope now you understand, right? Still, no. Now let's read the question again. So that the preference share were convertible into 8 fully paid ordinary shares of, can you underline 5? Underline 5. For every 2 fully 10% preference share of 20 each. An appropriate adjustment for the number of ordinary share issuable on conversion of the preference share is to be effected for any ordinary share split or consolidation that may be carried out. So remember, for every 2 preference share, you are getting 8 ordinary shares, each at 5. What about 10 million? We got 40, right? So that means we should 40 million shares, each at 5. But remember, you have already consolidated our shares. For every 2, you get 1, right, together. So now instead of 40, each at 5, you divide by 2, you consolidate, so that you have 20 shares, each at 10, and that's what to that. Any adjustment, an appropriate adjustment for the number of ordinary share issuable on conversion of preference share is to be effected for any ordinary share split or consolidation that may be carried out. Good. Number 7. The company made a net profit after tax of 225.75 million in the year that 1st of December 2013, and 262.6 million in the year ended that 1st of December 2014. So we are done waiting. Required. Basic earnings per share for each of the 2 years ended that 1st of December 2013 and 2014. How do you get the basic EPS? You take the profit after tax, you rest? Yeah, the preference dividend. If you raise the preference dividend, what do you get? Earnings attributable to any shareholders, and then you divide by the weighted shares. So now let's start with for 2013. How much was the profit after tax for 2013? You read note number 7. It was 225.75. Then you raise the preference dividends. Let's go to the second paragraph. On 1st of January 2013, the company had in issue 160 million ordinary shares and 30 million 10% convertible preference shares. So it's 10% of 30 million. Those are preference shares, right? How much was the par value per preference share? Read the first paragraph. Was it 20? Good, 20. That is 10% of 600, you get 6, right? So how much is the earnings attributable to ordinary shareholders? 1? 165.75. Now we do the same for 2014. Profit after tax. How much was the profit after tax for 2014? Yeah, it was an amount of 260. Yeah, 0.6. Then you raise the preference dividends. So it's the same. So it's 10% of that million, each at 20 times 9/12. Then you add 10% of 20 at 20 times 3/12. Give me that. 30 plus 25, that one you get 55. Give me the earnings attributable to ordinary shareholders. You get? 27 point. Have you understood what I have done here? Hii unaelewa nini sasa? Kama hamuelewi, That's very simple. Now let's be here. You see in 2014, 3 months to the end of the year, some preference shares were converted to ordinary share. How many months to the end of the year? 3 months to the end of the year. We are told that a holder of 10 million converted them 3 months to the end of the year. So what I have done, I've taken 10% of that million, each at 20. Then you determine the dividends for the first 9 months, 9 months plus 10%. Now, that million, a holder of 10 converted them. So that minus 10 you get. Now you'll have a balance of 20. And then the par value was 20 for the remaining 3 months. That's how I got that. So that means the basic EPS will be 2013, 2014. So you take 165. 165.75. This is 207.6. Then you divide by the weighted share. 2013, the weighted share we had was 219.2. And then 2014 we had was 173. 0.76. 1.1.2. Good. If you have to comment about the performance, 2013, 2014, how was the performance? Is it increasing or reducing? It is increasing, right? That's very wrong. I come to prove that. Let's go to number 2. Number 2. The restated basic EPS for the year ended that 1st December 2013 as at that 1st December 2014. Read that question again. Now, have you understood the question? No. Now, this is what happens. It's a requirement of IAS that 3. Now, whenever you're recognizing the earnings per share for the year, you have to show the comparative. Comparative, that means you show for even for the previous period, so that you can be able to compare. But what happens? You cannot compare this one and this one. So that's why you have to restate. How do we restate? The EPS for 2013 that will be shown together with for 2014. You don't just show this. You need to do some adjustment. And how do you adjust that? So what happens? We are adjusting the one for 2013. Earnings does not change. So what affects the EPS will be the number of shares. So you take the outstanding weighted shares. So you're saying that the earnings does not change. So what we need to adjust is the number of shares for 2013. So for 2013, the weighted shares was 219. Or you just take this, 219.2. Then you want to determine the earnings per share for 2013 that will be shown in 2014. Now you look at, from the weighted, you look at the share transaction that took place now in 2014 at no transaction. I mean at no consideration. You look at the share transaction in 2014 at no consideration. And the share transaction that took place in the subsequent financial year at no consideration. That's our 2014. So give me the transaction that took place at no consideration. They give you a list of shares issued at no consideration. What can you see there? Good. Number one, there was bonus issue of share. Bonus issue of share. So what was the term? The term of the issue was that for every 5 you get 1, right? Yes, so for every 5 you get 1. So what about 219.2? They have gotten a bonus of how much? Or you can also argue like this, like this. If 280, they got a bonus of 56. What about 219? So just use this, the same ratio. Sorry? 43.84. Then after every share transaction you sum up, give me the total. You get 263.04. Any other transaction at no consideration? Bills? No, conversion is not. You see, conversion is weighted. Are you together? A conversion is at consideration because the amount you are supposed to pay them now was reverted to the company. If you want to determine the shares at no consideration, we have not weighted them. Are you together? Yes. So what did we have? We had share consolidation. What was the terms? For every? You don't have to read the question. Everything is here. For every 2, you get 1, right? So you just divide by 2. Now we consolidate. How many shall you be having? 1? 1 at 1.52. Good. So that means there is stated EPS for 2013 that will be shown together with for 2014. You take earnings does not change, so it's 165.75. But now we have adjusted the denominator, the number of shares. So use the restated 131.52. 1.26. Then you also show for 2014. Now for 2014 was an amount of 1 point. How was the performance? Yes, that's how you restate. Good. So you can copy now. So our next class still will proceed with EPS. Now we have done the basic EPS. So next session we'll do diluted EPS.